Thank you, George, and good afternoon, and thank you for attending this presentation on fundamental indexing. As mentioned, my name is Sam Saif. I'm president of Claymore Investments. It's my great pleasure to have the opportunity today to introduce Mr. Rob Arnott, a partner of the organization and a good friend of ours. He's going to speak to you today about fundamental indexing, which has been getting significant attention and traction in the global institutional marketplace. Many of the largest institutions around the world, including here in Canada, are adopting research affiliates fundamental indexing, or as we call it, RAFI, as a core strategy to their beta management. Reason for this is because it works. We at Claymore are very proud to be partnered with Rob and his team at Research Affiliates, having launched several exchange-traded funds on the TSX based on the FTSE RAFI indices. Currently, we have 4 ETFs focused on Canada, the US, the global markets developed ex-US, as well as the Japanese marketplace. The real-world results have been proving a lot of what you will hear today, that these RAFI fundamental indices work and outperform their benchmark cap-weighted indices. This is not an investing fad, but simply a better beta. Rob is founder and chairman of Research Affiliates, a leading quantitative investment management firm based in Pasadena, California. Rob is one of the most experienced and well-known financial market theorists today in the market. Rob has over 27 years in investment management business and is extremely well known for both his global asset allocation and his quantitative strategies. Rob is past editor of the Financial Analyst Journal. Many CFAs would know this, the FAJ, which is one of the leading journalists for analysts today. And without further ado, I would like to turn things over to Rob Arnott, who will be joining us from his office in Pasadena, and then afterwards we'll do some Q&A. Rob?
Well, thank you very much for that kind introduction. It's a real privilege to have a chance to visit with the group there, even if only remotely. I apologize that my pretty hectic schedule made it impossible for me to actually be there in person. I would have enjoyed that, but hopefully this is a decent fallback to being there in person, and I look forward to interacting with you both during the remarks and during the Q&A that follows. What I'd like to do is to begin by framing the discussion about the fundamental index with an examination of the valuation of markets. When we're dealing with markets that are rising 10 or 15 or 20% a year in most years, now anything we invest in has 3 sources of return. You've got yield, you've got growth, and you've got changing valuation levels. We've had 7% real returns over and above inflation in the Evanston data going back 80 years. Over 10% total return. Take away 3% for inflation, you've got 7% real. It's really quite striking. 7% real return means that your real wealth doubles every 10 years. It's wonderful. But what are the constituent parts of that return? We see 4.25% came from income, from the yield on stocks. 1.25% came from growth. Earnings and dividend growth over and above inflation. That's a lot less than most people think. Going back over the last 100 years, we've seen 4 to 4.5% growth in earnings and dividends in the U.S. and fairly similar in Canada. And of that 4 to 4.5%, 3 was inflation. So therein lies an interesting challenge. Growth is not what people expect. It's likely to be less than that. A big chunk of the return, about 1.5%, came from rising PE ratios and falling yields. If we're looking at markets where the PE ratios have risen and yields have fallen, there we assume the returns of the past, or shouldn't we back out the returns that are attributable to the multiple expansion portion of the return? Absent multiple expansion, if PE ratios and yields were the same today as they were on average over the last 80 years, we'd have had 5.25 to 5.5% real, not 7. Now, 5.5 real is still pretty good, but are we going to get 4.2 from income? Not when yields are 1.8. So therein lies a problem. We're now back down to about a 3% real return, a 5 to 6% notional return. We can argue with these numbers. We can say, gosh, the yield is 1.8, but there's stock buybacks. Isn't that worth something? We could say real growth has been 1.25. But aren't we in a period of technological innovation that could fuel faster growth than in the past? Aren't companies retaining more of their earnings than ever before to fuel faster growth? But when we examine these hypotheses, they turn out to be pretty weak, and they turn out to be just as able to play the opposite direction, to lower the return expectations as to raise them. And in any event, make it very difficult to boost our expectations more than 1% or 1.5%. That still only gets us to maybe 4 or 4.5% above inflation, which is well below what most of us, most of our clients want to expect looking to the future. Now, our biggest bets are in equities. Most of the people at this conference, as with most conferences in our industry, have most of our money in stocks. Now, if most of our money is in stocks, and if stocks are not priced to give us the returns that we want, stocks become part of the problem. And therein lies a fundamental challenge. Well, what do we do in a world in which stocks and bonds are priced to give us less return than we really think we need and less than we would like to expect looking into the future? One thing we can do is actively manage the asset mix, move money out of markets that are expensive, that are trendy and comfortable. And comfortable assets aren't priced to provide superior returns. Move that money into markets that are more attractively priced, perhaps because they're a little bit out of favor. Another way to boost our returns is to look outside of mainstream stocks and bonds. Most of us have 95% of our money in mainstream stocks and bonds. What about the alternatives? They're worth a look. Another is to look for alpha. Find equity managers who can beat the stock market. Find bond managers who can beat the bond market. And that's the crux of our discussion today. If we're looking to beat the market by earning an alpha, there's two ways to do that. One is to look for sources of positive alpha and to hire them and bring them into the portfolio. The other is to look for sources of negative alpha and eliminate them. And one of the most interesting sources of negative alpha is that cap weighting has a return drag. And most performance measurement is done relative to cap-weighted benchmarks, and of course they don't have a performance drag relative to themselves. That would be impossible. But they have a return drag relative to their opportunity set, and that's what I'd like to explore. The efficient markets hypothesis has been with us for 50 years. So this capitalization-weighted indexation, cap-weighted indexation, was introduced in 1957 with the launch of the S&P 500. The notion of efficient markets was first proposed by Burt Malkiel and others back in the mid-50s. And one of the wonderful things about finance is that many of the innovators, many of the pioneers of some of the core principles of modern finance are still with us, and so we're still able to explore these ideas with them. But let's think about what the efficient markets hypothesis tells us. It tells us that the price of every asset is identically equal to its fair value for every single asset on every market around the world, every minute of every day. Now, how many people in the audience there really believe that's how the world works? Most practitioners believe that price is the market's best guess at fair value, that the market may get it wrong, and may get it wrong by a fairly good margin. That is to say, because fair value is really the discounting not of next quarter or next year's profits, but of decades of future cash flows. The fair value is actually rather nebulous, and the price is the best guess at that, but it could be fairly seriously wrong. Now, let's think about that for a minute. That means that price may be much too high for some companies, much too low for others. It means that the companies that are much too high, on average over time, most of them will underperform as the market seeks out fair value. The ones that are too low, on average over time, the market will seek out fair value and they will outperform. Now, the problem with cap weighting is that you have most of your money in the companies that are priced too high and likely to underperform. And you have too little in the companies that are undervalued that might have a good chance of producing incremental returns. Now, the areas may be symmetric, And the relative returns may be symmetric, but the weights aren't. The weights strictly, rigorously, consistently, and irrevocably favor the companies that ultimately turn out to be overvalued. So there are problems with capitalization-weighted indexes. One that sounds similar to the over and undervaluation problem that isn't is the growth bias. Some companies are trading at twice the market multiple. Cap weighting puts twice their economic weight into those companies. Some companies are out of favor and are at half the market multiple. Cap weighting puts half as much as their economic weight. So cap weighting puts the lion's share of our portfolio in the growth side of the economy. There's nothing wrong with that. You should put more in growth companies if you don't have to pay up too much for them. But the simple fact is that in an efficient market, the companies that are at twice the market multiple, you're prepaying for future growth that may or may not occur, and you're prepaying as if it's a fait accompli, as if it's already destined to happen. And so this growth bias turns out to pull us into every market bubble and every subsequent crash that comes along, whether it's a big, a medium, or a small bubble. Bubbles occur on the individual stock level. We've seen a lot of it over time, and in fact, any given day, you're going to have some companies where 10 years from now you could look back on them and say, well, yeah, that was a bubble. You have sector bubbles, you have country bubbles, and in 98, 99 you had a global bubble. So cap weighting has this structural bias that will put us into growth companies, and has this separate structural bias that will assure that we're overweight, overvalued companies. They are two distinct and different phenomena. What about cap weighting? Why are we so locked into cap weighting? Cap weighting has been with us for 50 years. It has been the dominant form of indexing. There have been equal weighted indexes and price weighted indexes, but these are tiny and at the margin and not used very widely. Pretty much all indexed money in the world is indexed on market cap. But we don't have to weight or select companies based on market cap. What if we did it just on size? Fortune magazine publishes the 500 largest companies by sales every year. It's the Fortune 500 list. And if you went back over the last 40 years and you just said, okay, who's on the Fortune 500? Let's weight them by sales. Not by market cap, but by sales. It's perfectly reasonable. Cap weighting winds up being an index of companies weighted by their stock market capitalization. So it's an index of how the total market performs. Why? Because the market is itself cap weighted. An index weighted by sales is an index of the companies in the broad economy weighted by how big the company is. Well, sales isn't the only measure of company size. Companies can be measured based on their profitability, based on sales, based on book value, based on dividends. You could even find oddball measures like aggregate indebtedness or number of employees. Thinking about this, what if we were to construct an index using each of these four measures? What if we were to take the equal weighted average of the weights using each of the four indexes? We wind up, in effect, saying that just as our footprint in the sand at the beach has multiple measures, length, width, and depth of the footprint, a company's footprint in the economy has multiple measures: sales, profits, book value, dividends. And by using the multiple measures, we get a nice approximate gauge of the footprint that a company has in the economy. If we pick the 1,000 largest companies, selected by fundamental size, ranked by fundamental size, and then weighted by fundamental size, what have we done? We've got an index that mirrors the broad economy, and far more important than that, we've got an index that severs that link between portfolio weight and over or undervaluation. You can think of this as an efficient portfolio for an inefficient market. If you believe that markets are perfectly efficient, then you can't be cap weighted, except by owning cap weighting on a leveraged basis. If you believe that the markets get it wrong, then anything that breaks the link between portfolio weight and over or under valuation is going to have the effect of boosting our long-term returns. And indeed, that's exactly what we found in our first study done in 2003 and 4 and published in 2005. We looked at putting $1 into U.S. stocks back in 1961. That's as far back as we could get good, clean, fundamental information about companies on at least 1,000 stocks. So, $1 put into the stock market in 1961. Invested in the 1,000 largest market cap companies, reconstituted once a year, every year, for the next 45 years. At the end of 06 would have been worth over $80. Well, taking $1 and turning it into $80 is wonderful, unless you could have had $200. Now, I'd like to draw your attention to what happened during the bubble, the aftermath of the bubble. Note here that the gray line nosedives, slides into a 2.5-year bear market, loses approximately half of its value. Meanwhile, the stock of the average company, weighted by company size, keeps marching higher. This is what first drew our attention to the problems of cap weighting. 2 years after the bubble burst, the average stock on the New York Stock Exchange was up over 20%. The index was down over 20%. That stark, enormous gap was, to me, a clarion call that cap weighting has structural flaws and that cap-weighted indexes do not track the performance of the average company's stock. They may track the performance of the average stock, cap-weighted, but not the average company's stock, because you were pulled into such heavy reliance on such tiny companies trading at such lofty multiples that you wound up with a 4,000 basis point gap between the performance of the average stock and the performance of the average company in just 2 years. Just astounding. The idea numerically presented shows average annual returns of 10.3% going back 45 years for the cap-weighted indexes. That's pretty good. It's enough to give you 80 times your money. The fundamental indexes are all 12 to 13%. They're nice and tightly clustered. They're remarkably close to the average of the four measures, which is in the ballpark of 12.5%. Well, that's 220 basis points above the cap-weighted indexes. There are active managers who I think would shoot their grandmother to get 200 basis points per annum excess return. The notion of doing it with just a dumb old index is quite remarkable. Now, there is dispersion. You find dividend indexing at 12.04. You find sales indexing at 12.95. So there is a range, but they're all within 40 to 50 basis points of the average, with the exception of the cap indexes. The cap indexes are the stark outliers, and they're outliers to the tune of over 200 basis points. Well, what that tells us is that there's a big difference between indexes constructed on fundamental measures and indexes constructed on market cap. What is that big difference? The big difference is that indexes constructed on market cap directly link, structurally link, the weight in the portfolio, the allocation to an individual stock, to the error in that stock's price. Now, Jack Bogle will fairly cheerfully acknowledge that, yeah, we overweight the overvalued and underweight the undervalued. But so what? Unless you can tell us which companies are overvalued and which companies are undervalued, you haven't said anything terribly useful. Well, as it turns out, you have said something useful if you find a way to sever that link. Now, one way to do it is to take the globe of mail to the wall and throw darts at it. That'll sever the link between over and undervaluation of portfolio weight, but it's a crude blunt instrument approach, and it will lead to a very illiquid, difficult portfolio to trade. With a fundamental index, you sever the link just as effectively, just as thoroughly, but you have an investable portfolio heavily reliant on large liquid companies. Now, you'll note that the risk for the fundamental indexes tends to be lower than the risk for the cap-weighted indexes. Not all of them, but most of them. You'll also note that the composite has a better return than the average of the 4 fundamental indexes and a lower risk than the average of the 4. So the Sharpe ratio is right at the top of the heap and is 50% higher than the Sharpe ratio for cap weighting. If we can boost our reward per unit of risk, our Sharpe ratio, by 50%, that's breathtaking. That's very important. And the statistical significance is off the charts. What about the character of returns? We find that there are monster bull markets in which the market is up 20 to 30% per annum on a 5-year basis. We find that the fundamental index at these times also produces 20 to 30% per annum returns, sometimes a little higher than the cap-weighted indexes, sometimes a little lower. We find that this pattern of returns winds up suggesting that fundamental indexing sometimes even beats monster bull markets and sometimes not. Why would it sometimes fail to add value if it severed the link between over and under valuation in the portfolio weight? Well, cap weighting hasn't. Very, very simple. Cap weighting has a structural growth bias. Companies with twice the market multiple get twice their economic weight. In a fundamental index, the valuation multiples are ignored completely, and the weight is the economic weight. So, if you have a growth-dominated market where growth companies are soaring and value companies are tumbling, that kind of market will boost the performance of any growth-dominated strategy, growth indexes and cap-weighted indexes. So in this context, a fundamental index is clearly a value index. It winds up producing returns with something of a value skew relative to cap weighting. And that's okay, because it falls out of the breaking of the link between over and under valuation and portfolio weight. But what about more moderate bull markets? Markets in the 10 to 20% a year range for 5 years? Those are big bull markets. And yet you'll notice that the fundamental index winds up outperforming the cap-weighted index almost all the time in moderate bull markets. In anemic markets, markets where the returns are single-digit or worse, it almost always wins, sometimes by absolutely enormous margins. So we find that the fundamental index winds up being a very powerful tool which produces returns in the way that we need them produced, adding tremendous value in markets that are disappointing. And it's easy to beat a disappointing market. All you need is a defensive investment strategy. It's tough to beat a difficult investment environment while at the same time keeping pace in bull markets. That's the beauty of the fundamental index. It does seem to, unlike most defensive strategies, it doesn't seem to take it back from you when times are good. Now, it does have a value tilt, so the question is this just another value index? This is a very common critique of the fundamental index. And the answer to that is very equivocal, yes and no. It is a value index. It always has a value tilt. It will never have a growth tilt. Why? Because growth companies are defined by their premium multiples. And premium multiples means that the market cap index is going to weight those companies above their economic scale. The fundamental index pays no attention to those multiples, and so it will always have a value tilt. If the market is paying a massive premium for growth, then the fundamental index may have a massive value tilt. If the market is paying a modest premium, it may have a modest value tilt. So it has a dynamic value tilt contra-trading against that and shifting expectations in the market. So what do we find? Russell 1000 Value has been with us for 28 years. It was launched in 1979. In that span, it has outperformed the S&P by about 1%, while reducing portfolio risk by about 1%. That's wonderful. Now, the fundamental index does not carve out all the growth companies. Google is in there. It's just in there at the economic scale. It doesn't eliminate the growth companies. It doesn't systematically bias towards growth or value. It ignores the valuation multiples. but relative to cap weighting, it does have a value tilt, which on average over time is about half the value tilt of the Russell Value Index. Now, if it's half as value tilted as the value index, it should add half as much value. Does it? No, it adds twice as much value, with more neutral, more market-like risk characteristics. So you wind up with something that has less tracking error, less value tilt, and more value added. If it's a value index, it certainly would appear to be a much better value index than the conventional ones. How is it a value index? On a snapshot basis, it is precisely a value index. Consider that the fundamental sales weight equals the cap weighting for a company times that company's relative sales to price ratio, linearly. So the sales weighting is linearly linked to cap weighting and to the relative sales to price ratio. It is a pure, unadulterated value measure. The book value index, same thing. The cash flow index, same thing. Dividend index, same thing. But the value tilt itself is dynamic. Here we can see that when the market is in a growth-dominated surge, where growth is beating value handily, the markets get stretched with growth stocks vastly more highly priced than value stocks. When that happens, the value tilt of the fundamental index soars, in this case soaring from about 0.5 to about 1.5. So tripling the value tilt of the fundamental index. This is one of the stark things about the fundamental index, that tilts change. A common misconception is that it has a small cap tilt. It doesn't. When the market is paying a premium for small cap companies, the fundamental index doesn't get drawn into that set of preferences in the market and doesn't weight the small cap companies at a higher weight. Cap weighting does. And so there are times, today is a perfect example, where we have a large cap tilt. We do have a small cap tilt whenever small cap companies are trading at a discounted multiple, because we're ignoring those multiples, so we put more into those than cap weighting does. But the reason for the perception that this has a small cap tilt is quite simply because the market usually has priced small cap companies at a discounted multiple. By contra-trading against that, you wind up with a little bit more in small cap. It's a very slight tilt. The value tilt is much more pronounced. Now we can use Fama-French analysis to do attribution on the returns. And the results are quite striking. Look at Russell 1000 here and RAFI 1000 here. You can see that the Fama-French factor exposure is pretty similar between the two. Small company bias is negative 0.15 for Russell, negative 0.10 for RAFI. That means that these actually have a 0.1 standard deviation, large cap tilt. Now the difference, the 0.05, means that on average over time, the RAFI portfolio has 1/20th of a standard deviation more small cap exposure than Russell. It's a tiny tilt. The value tilt is more pronounced. The Fama-French factor analysis says Russell 1000 with its factor loadings should have produced a 13.2% return. It produced 13.5, so it has an alpha relative to Fama-French of 0.3. The RAFI index, Fama-French says should have produced 15.5, it produced 15.8, so an alpha net of Fama-French factors of 0.3. There are folks who say, yes, the Fama-French factors account for the return of the fundamental index, so who needs the index? Reciprocally, we might say that if you use the Fama-French factors to create a portfolio that mirrors the size, value, and beta attributes of the RAFI index, and does so changing every month to the new style attributes, yes, you can get the same return, minus 30 basis points. But why would you want to go to all that trouble when all you have to do is own an index that weights companies by how big they are? And Speaking of which, the alpha is the same between the Russell 1000 and the RAFI 1000, it's 0.3. But the returns are very different. Do I want to focus on the alpha being the same or on the returns being 230 basis points different? The interesting thing is if you add Carhart's momentum factor, now RAFI 1000 is concentrating against momentum and yet is still earning good returns. The Russell does not concentrate against momentum, and as a consequence, their alpha is almost unchanged. With the Carhart factors included, we actually perform much better than one would expect that we should, given our size, value, beta, and momentum exposures. And what about small companies? Russell 2000, using the Fama French factors, should have had a return of 15.7%. It didn't. It returned 13.4%. RAFI should have had 16.7%. It didn't. It had 17%. So here you have a stark difference on both Fama French alpha and total return. I'm going to skip this one in the interest of time. This looks at value and growth partitioned in much the same way. The 20 largest holdings of the fundamental index are actually surprisingly similar to cap weighting. At the top of the list in market cap, you have General Electric 2.9%. At the bottom, ATT 0.75%. For the fundamental index, it's 2.9% for the top. It's 0.75 for the bottom. So those who think of this as being a much more broadly diversified portfolio, rather like equal weighting, they haven't done their homework. The fact is it's just as concentrated, but it's concentrated in big companies, not big stocks. The difference is highlighted when we look at things like Procter & Gamble here, number 5 on the cap list. The market is basically saying Procter & Gamble will be the 5th most important company to the U.S. economy in the decades that lie ahead. The fundamental index basically says, well, we don't care about what the market expects. Right now it's the 20th largest company. It's a perfectly good company. We'll put 0.75% in it. Reciprocally, the market says Chevron is 14th largest company in the future economy. And the fundamental index says, well, that may well be, but it's 10th largest in today's economy. These differences play out in the form of a significant reliance on companies that are big in today's economy and not a significant reliance on speculations and shifting expectations in the investment marketplace. This also plays out in rotation in the top 10 companies. If you look at this table, the top 10 by market cap are shown for every 5 years for the last 40 years. Back in 1965, you had ATT, General Motors, Standard of New Jersey, and so forth. 6th place, you had DuPont. It's marked in red. Why? Because in the next 5 years, it fell clear off the list. It went from 6th place right out of the top 10. It cratered. Now, we mark in blue and green newcomers. So you can see Xerox was a newcomer. Xerox took DuPont's place. The blue ones are special. They're flip-flops. They disappear as fast as they arrive. And so in so doing, they hurt us twice, where DuPont hurt us once by, if we were cap-weighted, having our 6th largest holding underperform so bad that it falls off the top 10. Xerox hurts us twice, once by having too little on the way up in the late 60s, and once by having too much on the way down in the 1970s. Now, the summary statistics tell an interesting story. You've got 23 companies that are fall angels. That means there have been 33 top 10 names in the last 40 years. 23 of them are gone. There have been 14 flip-flops, companies that appeared and then disappeared. Those 14 would each have hurt us twice. The fundamental index has many of the same names, but much less rotation. Back in 1965, you had GM, ATT, Standard of New Jersey. You had DuPont falling off the list again. 6th place, disappearing 5 years later. Why? Not only did the price crater in the next 5 years, their business fell off the rails. But look at the summary statistics. There are only 7 companies in the last 40 years that have ever been on the top 10 that aren't still there. There's only been one flip-flop, and that flip-flop was an interesting one. It was WorldCom. It was fraud. If you're weighting your index by how much a company has in sales, in profits, in book value, if they're lying about their sales, lying about their profits, and lying about their book value, this is not going to help you. You do find the same kind of chasing of fads, expectations, and bubbles in this graph, which shows the sector allocations over time. And I draw your attention to this segment in here, the electronic equipment segment, which is, loosely speaking, technology. And you can see the size of the bubble. It's immense. But you can also see before that there were smaller scale bubbles and crashes in technology all along the last 35 years. And that you wind up with peak exposure at the peak of a sector when it's about to fall off the cliff. Look at the peak of the bubble here in the year 2000 and look at the red band, 2 bands above technology. That's durables. What do we find with durables? We find that they were squeezed to almost nothing by the bubble, and then they tripled in the next 2 years. Well, what does that mean? We actually had very little invested in durables before they tripled. We had a great deal invested in technology before it was halved. There are bubbles and crashes all through this. John Maynard Keynes was one of the most important economists of the last century. He was also a legendary investor. And he was fond of saying, I don't invest in speculations or expectation. I invest in what companies own and produce. And what we find with a fundamental index is that you're investing in what companies own and produce. What are their net assets, the book value? What are their sales? What are their profits? What are their dividends? And so what we find is that that bubble in the year 2000 disappears. The weight in technology through the entire span of the bubble was relatively stable. You were constantly rebalancing back to it. But the weight was doubled from 40 years before. Why? Because technology was a bigger part of the economy than it was 40 years before. Now, this is all well and good. A lot of folks looked at this work and said, yeah, interesting results, but it's backtesting. Aren't you just data mining? And we, anticipating this, we asked Nomura in 2005, which had very deep databases, which at the time we didn't have. We now have those databases. We invited them to test the idea of the foreign market. This graph, this spaghetti graph, is the result of that study. They looked at the 23 countries in the MSCI and FTSE developed world markets, and they calculated the performance of a fundamental index, and they calculated the performance of a cap-weighted index for each of these. What did they find? They found that some countries, each of these lines of spaghetti is a country, is a relative wealth, fundamental weighting versus cap weighting in each country. So Greece here goes above 2. That means you have more than twice the endpoint wealth after 17 years in Greece if you fundamentally constructed your portfolios than if you cap weighted. The average was over a 50% pickup in returns. And the startling result was that it was positive in 23 out of 23 countries with no exceptions. We can see that here. The excess return column here shows positive value added in all 23 countries, no exceptions. We can see that in 21 out of 23, the results are over 100 basis points per annum compounded for 17 years. We can see that the average is 2.6%, meaning that the U.S. result was not just not an anomaly, it was actually below average. We can see that country allocation makes a difference, so that if you globalize the portfolio, this number down at the bottom of the table, 3.47, the value added for international portfolios is 3.5% per year. Why the difference? Why so much better than the average of the 23 countries? Because just as you can get bubbles, fads, and crashes in stocks and in sectors, you can get them in countries. So we find that you get an added boost from country rebalancing. This is the result for the average of the 23 countries. This is the result for the combination of the 23 countries globalized. What we find when you combine this across multiple markets is some pretty striking results. Going back over the last 23 years, if you invested in the All World ex-US index, you wound up with 9 times your money. If you took all the growth companies, all of the trendy, popular, comfortable companies, and just purged them from the portfolio, you wound up with 18 times your money. Value worked. If you put all those growth stocks back into the portfolio and reweighted everything in accordance with how big the company is, not how big it is perceived to be for the future, and for which people prepay today, you wind up with 24 times your money. Nearly twice the value added, but less than half the value tilt of the value indexes, because the growth stocks are all in there. This is what got Nomura's attention. They looked at the fact that cap weighting had in 22 years produced a scant 3 times our money, a lower multiple than it was almost 20 years ago. Quite startling. And yet, if you threw out all the growth stocks, you wind up with 4 times your money. You're still below where you were at the peak of the bubble in 1989. If you create and weight your portfolio based on the scale of the company, 5.5 times your money. And you're at a new all-time high, or with cap weighting, you need to see a gain of 40% to get a new high. What about less efficient space? The idea has had further out-of-sample tests in different domains. How well does it do in small companies? Small companies, the Russell 2000 index has been with us now for 28 years. Over that 28-year span, it would have made us 30 times our money. Throw out the trendy, popular bubble stocks, the dot-coms, all of the growth stocks in Russell 2000, and you get 52 times your money. That's marvelous. Put them all back in there and weight everything fundamentally, and you're at 75 times your money. Twice as much value added. Now what's interesting is that in Russell 2000 value, in Russell 2000 as compared to fundamental 2000, you don't get much of a value tilt. This is very different from the large company arena. And the reason for it is actually subtle but very powerful. There are companies in the Russell 1000 that aren't in the fundamental 1000. These are companies that are by definition little companies, trading at lofty multiples. The mega growth companies that are little, trendy, popular companies. Where do those fall in the fundamental weighting space? They're little companies, so they fall into our 2000. So we have some large cap growth companies in the fundamental 2000. Despite having large cap growth companies that largely offset the value tilt of the fundamental index, this adds more value than Russell 2000 value. It's quite a striking result. The idea has been tested in emerging markets. Now, emerging markets are very popular. Why? Because they've quadrupled in 4 years. Everybody wants their money to quadruple in 4 years, but people overlook the fact that it doubled in 13 years. That means that the prior 9 years was truly dreadful. It assumed there's no taxes. It assumed that markets are efficient and that all prices are correct. It assumed that all investors are rational and fully informed. It assumed that all investors can borrow and lend at the same risk-free rate and are perfectly willing to do so to an infinite scale. It assumed that all investors have the same risk tolerance. These are glaring simplifications that make the mathematics work so that you can prove that cap weighting can't be beat. All of the assumptions are false. All of the assumptions being false means that the capital asset pricing model doesn't prove that the market can't be beat, but one could reasonably infer that it's reasonably tough to beat the market given the results of the cap down. There are gaps between theory and reality. When empirical data contradicts theory, the temptation is to say, well, the theory is so elegant it can't be wrong. The data's got to be bad. That happens again and again. And what we find is that observers will claim to theory as fact. Tacitly, they're assuming the assumptions are correct, even though they know they're not. I think it makes sense to recognize that when we're looking at theory, and when we're looking at facts that contradict the theory, firstly, that's a wonderful opportunity to improve the theory. And secondly, it's a wonderful opportunity to profit for ourselves and our clients while waiting for the theory to be corrected. We can see a lot of examples. I'm not going to go through these in any detail, but a lot of examples of theories that are very elegant, very powerful, very useful, that are often mistaken for fact. Efficient markets hypothesis. I don't know of any empirical tests that solidly support EMH. Thousands of studies contradict it. Fisher-Black, when he moved from MIT to Goldman Sachs, was fond of saying the market looks a lot more efficient from the banks of the Charles than it does from the banks of the Hudson. And it fails the $100 bill paradox. If I'm walking down the street with Bert Malkiel, and there's a $100 bill on the street, I might bend over and pick it up, and Bert might say, hey, if that was really there, it would have been picked up a long time ago. You're wasting your energy. Now, in truth and fairness, and Bert's a good friend of mine, he would say that he's not that strong a believer in efficient markets, but that is tacitly what EMH says. Modern portfolio theory is exquisitely sensitive to the inputs, and the return covariance matrix is wrong. You'll come to the wrong asset mix. Capital asset pricing model, we've talked about those assumptions. Arbitrage pricing theory has the same assumptions. Miller-Modigliani that says dividend policy doesn't matter. It ignores taxes. It assumes all investors are rational and markets are efficient. It assumes that management acts in the sole interests of the shareholders. Now, I've seen one or two instances where that might not quite have been true. Black-Scholes assumes log normal price behavior, well-defined risk-free rate, and that risk is known. Cox-Ingersoll-Ross, sometimes called the CAP-M of bonds, it assumes that there's a fixed normal short rate as an anchor for mean reversion. It assumes that no other factors influence yield curve shape, and that volatility is solely a function of the short rate. Well, the assumptions throughout these are factually incorrect. Paul Samuelson suggested that very few economic writings have been concerned with useful theorems, operationally meaningful theorems, and that part of this has stemmed from a preconception that when you derive economic laws from prior assumptions, that those laws possess rigor and validity independent of any empirical behavior. He goes on to suggest that few economists have even gotten this far. The majority would have been glad to enunciate any meaningful theorems if they'd occurred to them. Simple reality is theory is not fact. It describes an ideal world. Empiricism, which contradicts theory, is not necessarily wrong. The empiricism might be correct. And that theory is improved by acknowledging its flaws and finding improvement, not by rejecting contradictory evidence. That concludes my formal remarks. I'm happy at this stage to open it up to whatever questions you may have.